Hey everyone, this is Robert Keene, so goldsilverpros.com. It is Friday, November 20th, 2020. And it looks like we're starting to see some cracks in the global debt system, starting off in China. And I'm going to show you where that's headed and some of the arguing back and forth between the Fed and the Treasury on the support programs and what that may mean for the solvency of the US and its own debt issues. We'll go ahead and get started. I wanted to start off by framing the conversation on what the debt is right now. We're over $60 trillion in current global public debt around the world. As you can see, the higher debt countries such as the US, a lot of the Western countries, China, Australia, Brazil, a lot of countries have a lot of debt, and this is a massive amount of debt that the world has never seen before. So when we talk about the debt, I wanted to use this graphic from The Economist to really sort of give an idea of what the debt looks like. And the debt is larger than it's ever been in human history. And it's something that we really haven't dealt with. We didn't deal with it in 2008, 2009 during the last financial crisis. It's only grown, and we're going to show you some comments from a former BIS president on that situation as we get here into the program. But this basically frames it for us. This tells us what the overall debt looks like and how bad it is. And it's something that we can't lose sight of. I know on this program, we talk about a lot of things as they relate to gold and silver, but this is one of the most important. Look at the debt around the world and how are you going to save yourself from debt default when this whole house of debt cards finally collapses. Here at Trading Economics, a look at the US debt. You can see the US debt has skyrocketed since we had the shutdowns in the spring. Since then, we've added a tremendous amount of debt in the US. Right now, it's sitting at that number, which is a whole ton of debt. It's a lot of debt. It's increased significantly since since the shutdowns, and it's had to. I mean, the Fed announced easing programs. Everybody was on board. We didn't want the economy to crash, and they just flooded the market with easy loans, easy money. And that has propped up mostly the bigger entities, as we'll see here later in this show. And while bankrupting some of the smaller ones and the smaller companies and people in the service sector, but that's what's happened. So we have exploded debt in the US. Of course, we're one of the red countries, one of the worst. You look over here, the public debt is 15 trillion, public debt per person, $50,000, and a population of 321 million as a percent of GDP, 93.6. And it's changed about 10% this year. We've added a tremendous amount of public debt this year. I wanted to show you an article from the CFR, the Council on Foreign Relations, is entitled The National Debt Dilemma. It was written on September 9th. They're talking about the national debt dilemma, and they're actually talking about the deficit here, which is the spending deficit, and looking at how bad the spending deficit is. And it's gotten almost to the point of how bad it was in the 1940s when we're at war and we had to take on a tremendous amount of debt for the war effort. We're not quite to that point, but we're getting pretty close. We haven't been anywhere near this level of debt since World War II, essentially. This level of deficit in spending since World War II. Of course, we haven't been anywhere near this level of debt in the United States or across the world ever. And as a percentage of GDP, the last time we were at this level of debt to GDP, it was back during World War II. So level of debt dating back to World War II is its highest, and the deficit is the highest. Now they've got this projected, which looks really rosy over here, but I don't care about projected numbers. I only care about actuals at this point. So we're looking at 2020 here, and it's gotten pretty bad in terms of deficit. And when you have a deficit like that, it means the debt's going to continue to go up, because how do you pay for deficits? You pay for them with debt. Interesting comments coming from William White, a former chief economist of the Bank for International Settlements, talking about how central banks keep shooting themselves in the foot. And I'm just going to read some of his quotes on the situation we're in, which I think are very, very good. He says here, today, the Canadian criticizes the central banks. They have pursued the wrong policies over the past 3 decades, which have caused ever higher debt and ever greater instability in the financial system. And he also goes on to admit that we know much less about the economy than we think we do. That's a stunning admission, because a lot of these popular world economists don't ever admit this. They don't admit that they don't have complete control of the system, that they don't know everything that's going on, that a cadre of elitist bureaucrats couldn't figure out, the entire multi-trillion-dollar economy and everything that's going on. Of course, it's obvious to any of us that really have studied economics, but it's stunning for this to actually come out in an interview from a former BIS chief economist. Central banks have no way out but to keep doing what they're doing, but by doing that, they're making it all worse. In other words, kicking the can down the road with the potential outcome being much worse in the future. They ask a question here. Let's focus on the fiscal side first. When is the time to withdraw the current support, meaning the easing that's going on across the world? And he says, certainly not now. There's still room for maneuver on the fiscal side, and we can still increase that room. Bond markets are wide open. Governments should use the current environment to borrow long and lock in cheap money while they can. So in other words, taking longer dated, almost forever dated or 30 plus year dated debt at cheaper rates to basically pay for the issues that you have now, the fiscal spending needs you have now. Going back to the CFR article, that's what he's talking about. Taking cheaper debt to take on these deficits. The question from the market is, are you worried about rising government debt levels? And here's what he says. What I'd like to see is clear guidelines from governments about how they intend to get debt levels down in the future. And he's not talking about German style debt break here, but guidance on what types of expenditure cuts and tax increases they'll be looking at. Notice how he talks about expenditure cuts and tax increases. So cutting entitlement programs and charging more people for taxes is really the only way out. And he admits that in this interview. And of course, we've been saying that for 10 years. You can't just quantitative ease and print money forever and expect there not to be consequences at some point. He says, Lord, give me chastity, but not yet. That was a big mistake after the global financial crisis. Most governments entered the austerity path too early and left the central bank's economy going. So he's saying they cut back too quickly and that caused issues. And so what they had to do afterwards is just open up the spigots, which they've done. And he's got some interesting comments about fiscal policy. I'm not going to go over those in this interview on this article, but I think you should read them about how he views fiscal policy. I'm not 100% on board with some of his conclusions, but overall, I think he does have some good conclusions here. I'm going to read through some of those. He says, we're on a slope where monetary policy has become increasingly ineffective in promoting real economic growth. Every crisis has met with monetary easing that caused debt and other imbalances to accumulate over time, and that caused the next crisis to be bigger than the previous one. And the next crisis then needed more punch from central banks. But since interest rates were never raised as much in upturns as they were lowered in downturns, the capacity to deliver that punch was decreasing. So because we never raised interest rates in times of growth, perhaps when we could cut back on some of the expansionary policy, it really diluted each new issuance of debt, that next new issuance of debt. That's why you have to have more and more debt to keep this system going as a percentage related to your spend. And that's why the system eventually has to collapse, because each new dollar of debt you have has less and less effect on expansion in the economy. I think we're down to something like 20 cents. Every dollar of debt is only having 20% effect on the economy. So we're negative 80 cents on every dollar of debt that we issue here in the United States. Question here, have central banks reached the end of the road? Just read what Bill Dudley, the former president of the New York Fed, wrote in Bloomberg a couple of weeks ago. He warns that central banks have run out of firepower. So this is former president of the New York Fed saying they've run out of firepower. And he warns that the side effects are getting worse. And this gentleman, a former economist with the BIS, says he agrees. That's the most dangerous effect of the past 30 years of monetary policy. Debt levels are constantly building up, and so the instabilities in the financial system. Aha. The question is, Jerome Powell tried to normalize monetary policy, but he had to stop after market panic in 2018. Is the Fed hostage to the financial markets? This is something I've been talking about since 2018. I've been harping over and over since 2018 on this very point. And this gentleman goes on to say, this is exactly my definition of the debt trap. Central banks know they can't leave interest rates as low as they are because they're inducing still more bad debt and bad behavior, but they can't raise rates because then they would trigger the very crisis they're trying to avoid. There's no way out to keep doing what they're doing, but by doing that, you're making it worse. So it goes on to talk about these things in the article. He goes back to say there's no return back to any form of normalcy without dealing with the debt overhang. In other words, you're going to have the debt collapse. I'm putting this in plain English. You're going to have the debt collapse before we ever get back to any sort of normal market society. He says, this is the elephant in the room. If we agree that the policy of the past 3 years has created an ever-growing mountain of debt and ever-rising instabilities in the system, then we have to deal with that. And how? Okay, so here's where it gets interesting. In theory, there are 4 ways to get rid of an overhang of bad debt. 1, households, corporations, governments try to save more to repay their debt. Well, how the hell are they going to save more when you're shutting down the economy and there's not enough dollars to go around? There's not enough employment to go around. a lot of the increase in social programs are because you chose to shut down the economy and now you're paying Americans to sit home. How are you going to save more without increasing the debt? You can't in that scenario. He says, but we know this gets you into Keynesian paradox of thrift where the economy collapses. Of course. So this way leads to disaster. Two, you can try to grow your way out of the debt overhang, though stronger real economic growth, but we know that a debt overhang impedes real economic growth. Of course, you can't do that. This leaves the two remaining ways: higher nominal growth, i.e. higher inflation, or try to get rid of the bad debt by restructuring and writing it off. So the same thing we've all been saying, the only choice is to hyperinflate or let the debt collapse. And this former BIS leading economist basically says the same thing. There's lots more to go in this interview. I want you guys to read through it. It's really good. The link is right up here. It's at themarket.ch. William White, central banks keep shooting themselves in the foot. You can find it on Google. We'll try to post a link down here in the text. But read through that. I mean, it's fantastic confirmation of everything we've been saying and how dire the situation is and how we don't want to lose sight of the situation. And that's why we want to own gold and silver, because that's the only thing that's going to protect you when the system collapses. Now, is the system collapsing? Well, let's see what Mnuchin says. He says people are misunderstanding the Fed funding decision. There's plenty of firepower. So this is big argument going on between the Fed and the Treasury. The Fed wants Treasury to continue a lot of these support programs. The Treasury is shutting some of them down. I'm not going to go through the specific ones, but they're shutting some of them down, saying this isn't compliance with the law and the spirit of the policy. But the Fed is griping because they're saying you're not allowing enough easing or enough support. So here, Treasury Secretary Steven Mnuchin moved Friday to downplay his department's decision to pull the plug on several Federal Reserve programs, saying there's plenty of money to provide funding where needed. This is a very simple thing. We're following the intent of Congress, Mnuchin told CNBC's Jim Cramer. It's not a political issue. It's very simple, Mnuchin said. Just a few minutes before Mnuchin's interview, Chicago Fed President Charles Evans told CNBC the Treasury move is disappointing. What I would say is to ask him to go read the law, which is very clear, or ask him to call the chair of the Congressional Committee, Mnuchin responded. So in other words, the Fed knows what happens when you turn off the spigot, even only part of the spigot. And the Treasury is basically saying, well, we don't need these. A lot of them weren't used as much as we thought, or we're not supposed to have them going this long. They weren't authorized, whatever the case may be. And so there's an argument going on with the Fed and the Treasury, because the Fed knows what happens when the system collapses. You can't stop supporting the system. And that's basically what the Fed is saying here. So again, things haven't collapsed here in the US, but what's going on in the rest of the world? Do things have to start here in the US, or could they start somewhere else? Remember, the entire banking system and debt system across the world is now integrated. That's what globalization did. It integrated all these together. So you can have a bank failure across the world, which gets set off the dominoes in the banking system everywhere, including the United States. Well, here we have another article by CNBC talking about a surprise spate of bond defaults by state-owned Chinese firms to spooky investors. Now, these are state-owned firms. These are government-owned firms in which China is basically pulling the plug, or they printed so much debt and they're still going out of business. So here's some article points to talk about from the CNBC article that came out yesterday. A series of high-profile defaults involving state-owned enterprises in China led to a bond market sell-off this week. Okay, these are defaults, meaning we can't pay the debt back. It's not kicking the can down the road and printing new debt. It's the actual default. Defaults by government-supported firms in China were rare before recent times. Aha, China never let these fail before. Now they're letting them default. Those defaults are coming even as many asset managers bullish on Chinese debt have this year been pushing their calls on investments, which are a very attractive proposition. So they've been saying it's very attractive because of the yields, but now that we have defaults, will investors still see it that way? What does this mean? In the article, it says a series of high-profile defaults involving state-owned companies in China, normally a safe pick for investors, have jolted the credit market and rattled investors. For example, state-owned miner Yangqing Coal and Electricity defaulted on a $1 billion bond last week, triggering a broadened state investigation into 3 underwriting banks for suspected of misconduct, meaning if you underwrote this, did you know that they wouldn't be able to pay those bonds back? Trouble in the debt system, and the banks are being gone after by the regulators in China. Other high-profile debt defaults followed suit this week, including government-backed chipmaker Tsinghua Unicorp, which missed payment after failing to extend its deadline for repayment, and another default by state-owned Shuaishan Automotive Group, a Chinese joint venture partner of BMW. And last month, one of China's largest property developers, China Evergrande, also came under the spotlight. So we've got a little bit more on Xinhua Unigroup from the Wall Street Journal. It says, key player in China's push for self-reliance in semiconductors has defaulted on a bond, adding to a recent spate of trouble in the country's corporate debt markets. And the credit rating group said late Monday that Unigroup was in default on the privately placed domestic bond worth 1.3 billion won. So now we're starting to see massive defaults in the Chinese market. What is that going to do to the rest of the world economy? Well, by itself, these are just a few billion here and there in yuan, which are basically hundreds of million in the US. Is that going to set off by itself all of the debt markets and the banks holding this debt in the world economy? No, because some governments can step in to bail them out. The banks could do some other things, maybe solve some assets. I mean, they could write some things off and people could take some haircuts. I mean, this by itself is not going to, but this is how it starts. It starts small. It usually starts in the emerging market economy, and then it builds through that economy, those economies, and then it spreads to the leading market economies, and then it infects the whole system. We're starting to see the cracking bubble of the cracking debt bubble. We're starting to see the collapse of debt across the world. It's starting right now. And this is something we said earlier this year. COVID popped the debt bubble, and we were exactly right. And that's exactly what is happening. So an article from the International Monetary Fund, caught by a cresting debt wave. Past debt crisis can reach developed economies to cope with COVID-19 financing shock. So in other words, COVID-19 caused the debt collapse, just what I just said. And here's an interesting little chart that they have in the IMF's blog post, Ballooning Debt, 1970-2019. The total amount of debt in emerging market and developing economies rose to an historic peak. Ballooning debt, government, private, you name it. Further down, there is quite another interesting chart. Even though we've had this higher debt, as shown by this green line, the output growth has plummeted. So percentage-wise, from 2010, it went from about 8% to less than 4%. That's more than a halving. While the debt went from about 110 to about 170, so about a 50% increase. So about a 50% increase in debt roughly, and about 105, 110% decrease in output. Again, what I said at the beginning of the video, when you get to a point in the Keynesian debt system, fiat debt system, where each level of debt that you issue has a decreasing amount of impact upon growth. And that's what we're seeing. We're still seeing positive growth in developing emerging market economies, but it's getting closer to zero. And they're having to gin up the debt by amazing amounts, even while growth plummets to zero. What happens when growth goes below zero? Now you have the snake eating its own tail and the system starts to collapse. So again, we're seeing that in China. We're seeing the defaults. It's being reported in the mainstream media press, something that William White is now coming out and talking about, something we have been talking about for a very, very long time. One last little chart and another IMF blog post called New Steps Are Needed to Improve Sovereign Debt Workouts. This was posted not that long ago, but it's talking about sovereign debt downgrades. So a surge in rating downgrades in 2020 has surpassed peaks in previous crises. 3-month sums of share sovereign downgrades 1980 to 2020. So look at the spike here in downgrades. Look at the spike we had in 2008. The last financial crisis went here. It's higher. The last time we had basically major inflation in the US, it's higher. It's the highest it's been since 1980. In 40 years, the sovereign debt downgrades are the highest they've ever been. Sovereign debt downgrades, national debt, national, treasuries are higher than they've been in 40 years. So we're seeing it in the sovereign debt, the issue with downgrades. We're seeing the defaults already happen in the commercial debt. How long is it before these defaults start to build and build and build and build and build? And before they start to affect the entire world economy and it all comes crashing down? We're not that far from it. So what we have said this year was that the shutdowns, not the virus itself, but the shutdowns as a result of the virus, were going to prick the bubble. That has now happened. We're seeing major debt defaults in Chinese state-owned companies. This is not something to be marginalized. We're starting to see economists from the BIS and the IMF and Council on Foreign Relations start to talk about these issues and document how we're at the end of this system where you can issue all the debt you want. It's not keeping the system up. You're starting to have arguments in the US between the Fed and the Treasury on what to do. And the Treasury is saying, we're trying to have some semblance of normalcy here. And the Fed saying, you can't do this or you're going to cause panic. It's coming to the US. Now, are we as bad as China is right now or some of the emerging market economies? No. Are we going to get there? Absolutely. And it's going to be those ripples through the system. It's going to be the dominoes starting to fall through those bad debts, which are going to start crashing the banks. And then who's going to come in to support it? The IMF, the BIS? If it's across the world, who stops it this time? It's not like Japan where they had their stagflationary episodes and the rest of the world financed that for them. It's across the world. There's nowhere to go. No international agency like the IMF has enough firepower to stop this, especially when we know when you issue new debt, it doesn't have that much of an effect anyway. It's having a decreasing negative effect on growth, meaning the system's eating itself. And when it all goes negative, it's going to crash. We're not that far from it. All the charts I just showed you we're not that far from it. So I know a lot of people have been frustrated with the gold and silver trade right now. You're worried about manipulation. You're worried about Bitcoin going up. You're worried about the stock market. Don't worry about all that stuff. That stuff does not have a 5,000 and 6,000 year history like gold and silver do respectively of being money and of being safe alternatives in times of crisis. And we are going to have the biggest debt crisis in the history of this rock known as planet Earth that's going to hit us. And the only way out is gold and silver. Sorry for all you Bitcoiners. It's not that proven. It's got issues. Now, am I against you holding Bitcoin? No, but it's going to be gold and silver. Gold and silver is what's going to catch the wave. It's what's going to protect you when this comes, and it's coming. I wanted to do this video before Thanksgiving. We have a lot to be thankful for in this country. It's still the greatest place to live, I believe. And you know, until that's not the case, I'm going to say it. And we have a lot to be thankful for: our health, our families, our country, the opportunities that we have. And we should be thankful for that. But we should also prepare for what's coming. And we need to prepare with the things that have been proven over millennia to protect. And that's gold and silver. And that's why we have the website Gold Silver Pros. That's why we do these videos. I haven't talked about the debt issue here in a while. I really wanted to reiterate it because it matters, and it's going to be what collapses this whole system. And I still think it's going to be a black swan, probably in the commercial banking system, that really kicks it off. Now, that kicks it off to the point where everybody panics. Now, are people panicking about the Chinese state-owned entities defaulting? No. Is it big enough to take it down by itself? No, but that's going to ripple through the system. And when somebody like a Deutsche Bank or one of those types of size banks start to collapse, then you're going to see people panic like you have never seen before. Yes, the cryptos will get bid up, but they're not going to be able to handle the volume. It's going to be gold and silver. That's what's going to protect you. That's why we do this channel. That's why I'm bringing you this video today, guys. I hope you have a wonderful weekend. I'm going to go ahead and end it here. I hope you have a wonderful weekend. I will see you again before Thanksgiving, but I also hope you have a wonderful Thanksgiving with your families. Please take the time off to recharge and regenerate. There's been so much going on this year. Just regenerate, spend the time with your families, disconnect from all the computer systems in the matrix, get your time with your families and your loved ones. Be thankful for what you have, and remember to protect yourself as much as you can. Keep coming back to the channel. We're going to keep an eye on this. We're going to tell you what's coming the best that we can, given the data that I can find. And we're going to make recommendations to help you survive this. That's what we're here for. So until next time, this is Robert Keens with GoldSilverPros.com.